Well, hey there, everyone. Welcome to a somewhat late kickoff to our normal time, but welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a beautiful, sunny and warm Boston, Massachusetts. We're on the East Coast here for the remainder of this week, heading up to New Hampshire over the weekend, and then back home to Redmond, Washington. But for now, thanks for being flexible as I travel around and get to the show as soon as I can. Really excited to catch up with some Bostonians in the area tomorrow and talk charts and talk markets. And I'll share with you some of the insights. Of course, as always, looking at the market conditions here today, ended up being pretty a decent day, I would say overall, right? And you would say the breadth conditions improved a bit. We've had some weaker breadth so far this week, really coming from last week. We're seeing a little bit of better breadth readings, as you'll see today. Major averages finishing slightly higher. Not too bad. Let's take a look and see what we can see on the charts here. The S&P 500 up about 1/3% at the close, up to 6263 and change. The NASDAQ Composite up about 1/4%. The Dow, the best of the three, up about 0.5%. Mid caps, small caps, all up as well. The VIX slightly lower today, so still in that low volatility environment. But take a look at the intraday chart of the VIX, and you can see it spiked almost to 20 today. So kind of a weird day, right? You have that spike lower going into a sort of that 11 o'clock hour Eastern time, and then a nice spike higher, drifted higher through the course of the trading day. So the VIX almost, midday, as I'm on the plane checking the markets, looked like we might actually get a VIX a level above 20, but wasn't to be. By the close, we're actually right back where we started the day yesterday. All right, looking at interest rates, you can see the 10-year yield around 4.45, the long bond yield holding just above 5%. The 5-year point ended up just below 4% at the close. The dollar index slightly lower. Not a ton of movement in the fixed income markets, to be honest with you. In the commodity space, gold and silver both finishing higher. We've been talking recently about the improvement in silver, right? If you look at silver, gold, and copper, only one of those does not look like the other, and it's gold. Gold's been kind of flat in the month of July, while silver's been drifting higher. Copper prices have been improving. So if you've been riding the golden wave higher, as I definitely have, maybe something to think about. Maybe elsewhere in precious metals and industrial metals, maybe an interesting opportunity to diversify. Crude oil prices basically flat for the day. The energy sector at the bottom of the list. All right, we have, because we're doing the later kickoff here, this is actually, we're right at that 24-hour rotation for Bitcoin, right? Bitcoin, Ethereum, other cryptocurrencies trade 24 hours. So similar to spot currency markets like the euro and the yen and the Swiss franc, you can sort of pick one moment in the 24-hour period, and that's kind of the close, quote unquote, just so you have daily price data to sort of analyze and understand. And we're right at that 24-hour period here today at 8 o'clock Eastern. So Bitcoin basically flat for now, but that's just because we basically just restarted the 24-hour timer. So if you look at the last 24 hours, Bitcoin's actually been generally trending higher. It did briefly get above 120,000 earlier in the day Eastern time. Currently trading just below 119,000 as we go live. Ether prices as well, really improving. So while Bitcoin has been kind of flat, Ethereum has actually been outperforming fairly dramatically. I actually grabbed the price of Ethereum to take a look at that with you a little later in the show today. All right, looking at the 11 S&P sectors, almost all of them up. So again, not a huge up day, but a decent day after some distribution days. Kind of a nice pause in that trend, as healthcare up 1.25%, real estate up just over 1%, financials up 0.7%. It's good to see financials actually up there at the top of the leaderboard, or toward the top, given some of the deterioration that we've seen. Some of the big banks have reported earnings and gotten crushed pretty quickly in their post-earning movement. So nice to see some of those stocks kind of licking their wounds and bouncing higher a bit. Energy, as I mentioned, the worst performer, down 0.9%. Utilities were flat for the day. Consumer discretionary, not much better, to be honest with you. All right, continuing on. I mentioned the breadth was a little bit better today. We've had some concerning breadth readings. We've talked earlier this week about the NASDAQ bullish percent index breaking below 70%. We've talked about the Stocks above moving averages starting to come out of extreme bullish levels now to more, sort of standard bullish levels. We'll talk about the McClellan oscillator a little bit later, which actually turned negative earlier this week. But for today, advanced decline data, not too bad, right? The S&P 500, about a 2-to-1 ratio of stocks up versus down. The New York Composite Index, 59, we'll call it 60% advancers versus 37% decliners. Small caps had the best breadth. So overall, I mean, decent day with most stocks closing higher. And I think that's encouraging. Again, we talked about the negative breadth recently. And the question is, how much does that negative breadth translate into price deterioration? We haven't had a ton of that yet. And a day like today, nice breather in that little distribution sign that we've been seeing. All right, looking at the Magnificent Seven and friends, leading growth names. Tesla, as you can see, up 3.5%. Alphabet, Apple, both up about 0.5% today. Amazon down 1.4%. That's the worst performer. Meta, in a chart that is looking suspiciously more and more like a big double top pattern, down another 1.1%. Netflix down 0.8%. That's going into their earnings release. That's the first of the Magnificent Seven names to report. They'll be reporting tomorrow, I think after the close. All right, we'll continue on here. And again, apologies for kicking off late. Had to figure out how to get to Boston and get to a hotel and get some dinner and then get the show going. So I appreciate your flexibility. Thanks, those of you, the troopers that are tuning in a little bit later than normal. If you're watching the replay on our YouTube channel, thanks for checking it out. Please drop questions as they come. Just put it in the comment section anywhere you're live streaming it or on the replay. We'll take a question or two from the live comments, but any questions are welcome. We're planning an all mailbag episode on Friday of this week, and we'd love to answer one of your questions there for sure. All right, let us continue on looking at the market carpet. This is a heat map style visualization. Kind of a neutral day here, right? You can see some things that were up and not a ton that was down a lot, but the green and the red really stands out. And that's what sort of a flat neutral day sort of looks like. Average color, kind of neutral amber. You've got some things closing up on the day, things closing down on the day. So let's focus our attention on sort of the barbells, right? The things that are really moving at the extremes. So I'm immediately drawn to a bunch of green here in the middle, Tesla being one of those, but I'm really way more interested in some of the healthcare names, right? 4 of the top, we'll call it 7 healthcare names, 7 or 8 healthcare names finishing in the green today. Eli Lilly, Johnson & Johnson, AbbVie, Amgen, all having decent updates today. And healthcare has not been a particularly strong sector on a relative basis, to be sure. And some of these charts, honestly, I mean, Eli Lilly, still not a great chart. Still sort of languishing below $800 a share. AbbVie still has much more to prove in terms of improvement. Johnson & Johnson, though, with this rally really breaking out, the problem is it's accelerated up to a fairly well-established resistance level. I grabbed the daily and the weekly chart of Johnny John. We'll look at that in a little bit. You'll see what I mean. So, it's on the surface, always super encouraging when a sleepy blue chip name like Johnson & Johnson has a big up move like we saw today. The question, I would argue, is sustainability, right? How much further upside do you have after that initial move? That's where I'm questioning the chart of JNJ a little bit more. Not a lot to get excited about in the technology sector. We can talk about Oracle making a new all-time high. That's fair. We can talk about AMD hitting 160. That's impressive. Not quite to a new high, but getting there. But the average chart was not great in the technology sector. And this is one of those things we've been talking about here recently, and certainly this week is a bit of a wake-up call, I would argue, right? The sustainability of the uptrend that we've seen in the S&P and the NASDAQ, driven in no small part, arguably predominantly by the strength in technology and other leading growth names. And if that starts to change, it doesn't mean that certain stocks can't do quite well, right? You could see healthcare all of a sudden start to improve, or financials start to take on a leadership role. Even industrials or maybe even consumer staples start to see some strength there. But the problem is there's been a lot of optimism baked into these markets, driven by ridiculously high valuations in tech and communication services names. And if we start to see technical signs that investors are kind of waking up to those valuation concerns, recognizing that these runs may not be sustainable, that's where I think we have some potential issues. All of this seems to be happening, by the way, as we near the seasonally weakest part of the year. kind of that August, September timeframe, that's usually when pullbacks happen. That is rarely when you see a lot of strength. It's usually when markets naturally pull back going into a major low in the fall. So some of these lack of accumulation signs I'm seeing in technology definitely have me thinking that's something that could be coming pretty soon here. All right, let us finish off if we can and go to some charts. I've hand selected some charts to review with you. We're going to do a little shorter episode tonight just because of the late kickoff. I appreciate you hanging in with me and asking questions. If you have questions, if you're watching live, please pop them in now. We'll grab a question or two at the end of the episode. Any of the questions we don't get to, we'll put it in the mailbag and hope to answer one of your questions in our Friday all mailbag episode. All right, daily chart of the S&P 500. Yesterday we talked about, sorry about that. Yesterday we talked about the bearish engulfing pattern, which is where you have an up day followed by a down day. Day one's open to close range is engulfed or contained by the open to close ratio on or open to close range on day two. Today we actually sold off quite a bit, and so earlier in the day, and again I was flying for sort of much of the trading day today. And as I'm checking in on the markets randomly on the airplane, I'm seeing things rotate lower mid-morning. I'm thinking, ooh, this could be a really interesting distribution day. But by the close, we got right back to the top. Now, don't ask me whether you call this a hammer candle or a hanging man candle. I would argue it's kind of this weird nebulous, I'm not quite sure candle, because we're sort of sideways right now, right? We're not really in a clear uptrend. Although you could argue we're basically in an uptrend, over the medium term time frame, but we've been sort of sideways a little bit, and so we've been consolidating, right? It's sort of a question mark. So I probably, if you force me to pick one, I'd call this a hanging man candle. So, but what does that really mean? I'm not sure. This is sort of a weird candle. Generally speaking, this sort of move intraday after the distribution yesterday, the sell-off in the morning, the rally into the close, I probably think that means short-term bullish sentiment, but it's not a clear-cut example. And I can give you a much more long-winded, delineation of all the technical nuances of what I'm seeing here this week. But I would say it's a little bit unclear, which makes sense because I would argue the markets in general are relatively cloudy in terms of their clarity right now. Looking at a couple of breadth indicators, we highlighted this one. I just wanted to keep this one in the rotation just to see as there are changes what sort of significant moves we've had. This indicator is looking at moving average breadth. So the percent of S&P names above their 200-day, percent of S&P names above their 50-day. That latter one, the stocks above their 50-day, finished today around 64%. That's not bad. That's sort of, run-of-the-mill bullish reading in that indicator. The danger sign is when this indicator gets below 50%. And, pro tip on using a platform like stock charts, the alerts functionality, which is a way that you can set price alerts on anything. I tend to think of this for, ETFs, for stocks. When Meta breaks above resistance, set an alert. I think it's super important for that. But don't forget the benefits of using it for breadth indicators. So this ticker right here, $SPXA50R on stock charts, is a daily index. It updates intraday now, tracking the percent of S&P members above the 50-day moving average. So if you, like me, are concerned about when it would break below 50%, set an alert. Use that ticker, set a price alert, and say, tell me when this index breaks below 50%. Then you don't have to worry about it. You don't have to keep tracking this chart. You don't have to keep revisiting it. The platform will email you. It'll pop up on your mobile device. It'll put a headline at the top of the screen. And stock charts isn't the only one to do those sorts of things. I just know the breadth data is very good, and it is built into the alert system. Not all platforms have that sort of all syncing up. But I would encourage you to take advantage of things like that. When I think about the benefits of doing technical analysis in 2025, the computing power that you have available on a laptop, on your phone, pretty unprecedented. Let's take advantage of it, right? Let's make life a little easier. So set alerts on some of those breadth indicators. If there's anytime you look at a chart and you say, boy, if it hits X, I would be concerned. Don't think anymore. Just set an alert, and then you don't have to worry about it. The McClellan oscillator, speaking of another breadth indicator, and this is a short-term breadth indicator by design. This was an indicator that was derived from advanced decline data many, many years ago. Sherman McClellan and Marion McClellan developed this indicator as a way of taking the advanced decline data and turning it into an oscillator, turning it into more of a short-term gauge so that they could think about tactical movements in the markets. And I find it really helpful in an environment like this, when the market's moving to new swing highs, to just look for when the McClellan oscillator breaks below zero. No guarantee that that's the end of the uptrend or that that's a big rotation. There are other breadth indicators, longer term indicators we can look at to make that assessment. This is just telling us in the short term, the breadth is starting to shift. And that's what compels me to pay a little more attention to breadth, pay a little more attention to support levels, focus on key important levels, and just see if they're able to hold. So I have to tell you, the McClellan oscillator below zero earlier this week, remaining below zero through today's close, it looks most likely. All right, we've highlighted Bitcoin as sort of testing all-time highs. We've broke above 120,000 for the first time. We're kind of right there as we record the show here in the evening on Wednesday, July 16th. I did want to highlight, though, that in the month of July, Ethereum is actually the place to be. Ether prices have rallied pretty consistently, while Bitcoin is sort of failing to get above that recent swing high and sustain those gains. Ethereum prices are actually trending higher in a big way. Broke above 3,000, which is pretty important. I like to keep an eye on the big round numbers, big 1,000 increments on charts like Ethereum and Bitcoin, because more often than not, they tend to be pretty relevant. You can see that Ethereum recently breaking above $3,000, and you can see 4,000 is basically the all-time high from December of 2024. I would say the fact that we've broken above resistance, broken above moving averages, now breaking above big round numbers, I think those all-time highs are the next next pivot point I would be eyeing on the upside. Now, this is a chart that's extremely overbought. That usually means if you get a pullback, you probably get at least another high before all is said and done. That's what extremely overbought with an RSI above 80 actually ends up being a pretty encouraging long-term signal. So that's something I would highlight here on the chart of Ethereum. And full disclosure, I do own Ethereum in my own accounts. Coinbase as a way to play on cryptocurrencies, right? If you're looking for exposure to cryptos, more options than ever, right at this point. Between obviously having a digital wallet has been the way to do it historically. Opening a Coinbase account where they're basically custodians of your digital wallet for all intents and purposes. But you can also buy Bitcoin ETFs and exchange traded products, or you could just buy Coinbase, where it's basically a play on cryptocurrencies, because that's pretty much their business. In the news today, Coinbase, because they announced, I think it was called the Base app. They're really trying to, and this is one of the things I've been looking for with Coinbase, right? The bull market on Coinbase is either all about cryptocurrencies or it's other things. Coinbase, being an app that everyone uses, starts to build into other things. And that's what it looks like they're trying to do. They actually have a Base app, which they announced, which is going to include messaging, direct messages. It's going to include stable coins and transactions, your Coinbase wallet, but also other things, right? So they're trying to tap into people that are not big crypto traders, but are trying to do other things and try to make Coinbase the everything app. How many companies have tried to do something like that? But Coinbase now getting in the game, and for now, the market treating that with a decent amount of optimism, with Coinbase making a new high, closing just almost above $400 a share at the close. I was preparing a presentation for a webcast next week, and this is one of the charts that I identify that I wanted to talk about. Just want to focus on the returns. Take a big step back with me from your monitor and think about the returns in the U.S. equity markets and the U.S. markets as a whole from the April low in the first weeks of April. We saw that the end of that deterioration off of the February peak. Now the market obviously quite resilient, making new highs. So what's been the leadership out of that April low? The Magnificent 7 ETF, ticker MAGS, which includes like Magnificent 7 and other similar names, up almost 40% just off of that April low. The QQQ, the NASDAQ 100, up 34%. The S&P 500 up 26%. Equal weighted S&P up 20%. Gold up 12%. Let's look at each of these comparisons and just think about what that means. So the Magnificent Seven has outperformed the QQQ off of that April low by about 500 basis points or 5%. 5%. So what does that mean? That means the Nasdaq 100 leading growth stocks have done quite well, but the biggest leading names, those Mag 7 names, have been the strongest performers. Look at the next comparison, the Nasdaq 100 versus the S&P. The Nasdaq 100 outperforming the S&P by about 800 basis points or 8%. So that shows you that large cap growth has been much better than the S&P 500, a broader universe. Now the next comparison, S&P up 26, equal weighted S&P up 20%. So what that differential represents is basically how much does it matter to own the biggest names in the S&P versus just kind of a broad, swath of S&P 500 stocks. The equal weighted S&P Meta is worth the same as Cheesecake Factory, whatever random S&P 500 name you want to throw in there, right? They're all treated equally. They're equal weighted. So when the S&P is outperforming the equal weighted, that basically says the largest names are having the largest gains. Finally, the equal weighted S&P is well over gold, again, off of that low. So gold has outperformed all of these year to date, but off of the April low, you can see that all of the other indexes have outperformed gold. Gold's still up 12%, so doing fine off of the April low. But that order of operations of these different ETFs, I think, tells the story of the leadership trends. And I think when we've talked about technology and overvaluations and potentially stalling out here, this is the chart that comes to mind because this is define the market off of the April low. And if that starts to change and if that dominance of large cap growth starts to evolve, that's where this market can all of a sudden look very, very different very, very quickly. All right, a couple more charts and we'll take a couple questions. We'll call it an evening. Johnny John making a new swing high, a new 3-month high. Love to see it. Classic blue chip defensive name, decent dividend yield. One of those sort of tried and true stocks, but not the most exciting name out there. It's not one that's been dominating on a relative basis. Certainly year to date, it's basically been flat. So we had this big gap higher, which is encouraging. The problem is we're actually rallying right up to the February-March peak, right around 168. Let's look at the weekly chart, and you can see when we look at the unadjusted data, so basically stripping out the dividend adjustments, you can see that Johnson & Johnson actually rallying up to a very consistent resistance level. Sort of late summer 2024, we hit a peak around 169. In early 2025, we'll call that 170. We've now rallied up right into those peaks. So the rally has been encouraging. I love the bounce off of the lows, but is there enough momentum to break above that high and go further? This has been more of a cyclical trading type of name. This has not been a big trending name like we saw back coming out of the COVID low in 2020 and 2021. This is kind of the juice. This is one of those stocks that was actually working quite well going into mid 2022. From there, it's really been consolidating while the major averages have been improving quite a bit, certainly in recent months. So keep an eye on Johnson & Johnson. I think getting above resistance would be quite encouraging. It's a lot to ask right now. All right, last chart, Roblox. My son is big time into Roblox. He even has me circled in playing some random games with him. As soon as we're done, I might jump on and get back with him in Redmond playing a game or two just to have fun and chat it up a little bit. But boy, I tell you what, talk about a business model that is working. The market is rewarding Roblox with further all-time highs. This is a company that is not turning much of a profit. You can see the PE and EPS numbers are negative, but the trend overall is quite positive, right? So we've seen a consistent uptrend of higher highs and higher lows. You can argue that a chart like Roblox is super frothy. I won't argue with that fundamental part of it. You could argue that it's unreasonable that a stock like this should be doing this given its inability to actually generate and grow earnings. I won't argue with there either. What I will tell you, though, is regardless of those things, the trend is positive. So as a trend follower, I look at the moving averages in the proper order, right? Moving price making new highs, higher lows, above an upward sloping 21-day EMA, which is above an upward sloping 50-day moving average, which is above an upward sloping 200-day moving average. Get nervous when that is no longer the case. Price 21-day, 50-day, 200-day. This is a chart in a primary uptrend. Get concerned when it's no longer in a primary uptrend. For now, onward and ever upward, I would say, until proven otherwise, right? All right. Thanks so much, those of you absolute troopers tuning in live. I appreciate you so much doing so. I hope you found this helpful and not too much rambling here. I will take a question or two. Any of the questions we don't get to, we'll put it in the mailbag and would love to dig in a little deeper on Friday. Akira-san, thanks so much for watching on YouTube. You ask, hi, Dave. Thanks for showing how chandelier exits provide valuable information. Does the use of chandelier exits vary by market cap? Large versus small caps, or securities versus ETFs, or same applies to all? Really awesome question, Akira, and I appreciate you so much asking about that. We've talked a lot about the chandelier exits. When asked about a stop approach, I often tell people the chandelier exit system is a really good place to get to. A lot, if again, I mean, number one, most important, have an exit strategy. That's what I tell people. Even if it's not a perfect one, have an exit strategy, right? Say if you have nothing else in your toolkit, sell a stock when it gets 8% below your entry point. It's not perfect. It's not ideal. It's not scalable, but it's going to prevent you from climactic losses. And that's what really is going to crush your portfolio. It's not paper cuts of little losses. It's the big loss that all of a sudden torpedoes a position, and then you have to eat it and take on a huge loss in your portfolio. So keep your losses small, let your winners run. That's what we're trying to get to. Now, chandelier exits are great because they're based on average true range. That means it's based on volatility. That means it's much more sensitive to the actual movements in the stock. And I think that's kind of an important thing to pay attention to. So your question was, is it, do you have to adjust it, or is it good for other things? It actually is. And that's the beauty of the calculation, right? When it's calculated on average true range, what that means is literally the indicator is looking at how wide the range is every day, right? What's the range from the high to the low? And the average true range, the average range means you're looking at the average high to low range over a period of time. And true range means you're adjusting it for gaps, right? So if there's a big gap in the stock, that's actually included in your calculation. Roblox actually doesn't have a ton of gaps like back here. Average true range means the average daily high to low range adjusted for price gaps. So what that means is the more volatile the stock, the wider the stop. The less volatile the stock, the narrower the stop, which is how you should do it, right? Because otherwise you're going to get a lot of false signals or no signals at all. So the good news about chandelier exits, works pretty well for large caps, mid caps, small caps, ETFs. I don't think you need to adjust it a ton in my experience. It's a pretty good starting point. If you would want to, at the end of the day, an indicator like this is trying to help you make the decisions you need to make. It's trying to help you answer the questions that you're asking. So if you find that you're getting a lot of whipsaws, meaning a lot of false signals, then you want to up the sensitivity or actually make it less sensitive, right? Up the periods, which is going to give it a little wider swings to deal with. If you find that it's never triggering and there are these pullbacks that aren't getting triggered, then dial the number down a little bit and it'll make it a little more sensitive. So the good news about technical indicators, you can adjust them. If you find it's not perfect for what you're trying to do, make it more or less sensitive. And that's true with RSI. That's true with MACD, any of the indicators that we talk about. That's the benefit of being able to tweak the settings. But what you don't want to do is start curve fitting and try to make this perfect setting for each chart. Come up with something that's going to generally work. So the default settings on the chandelier exit, pretty good starting point. Start there, tweak it from there, but should be good on equities, on ETFs. I've used it all across different asset classes and have had very few issues. All right, let's take one more question. Joaquin, thank you for watching on YouTube. Equal weighted S&P, I think equal weighted S&P you're talking about, found support at the 21-day EMA. I love your question because as I was showing those different ETFs, right? The cap weighted S&P, well, the Mag 7, the NASDAQ, the S&P, the equal weighted S&P. What's so helpful is looking at how those different ETFs or indexes actually hit different support levels, right? Is one of them breaking down and the other one does not? And if you have a situation where the equal weighted S&P starts to rotate lower, but the cap weighted S&P does not, if the Magnificent Seven is making a new swing low and the equal-weighted S&P starts to rotate higher, that is a brilliant way of understanding leadership. So the three things I do, the three charts that I kind of would keep in mind to really understand leadership themes, one would be something like this, where you're just looking at different key parts of the equity market and looking for rotations. I have another chart on my one of my chart lists that I look at has the Morningstar style boxes, like large cap growth, mid cap core, small cap value, and all those other combinations. That is a great chart to just recognize, okay, something had not been working and now it's starting to work. Something might be different. That's chart number one that I would look at in terms of leadership. Second thing I would look at would be these defensive sector ETFs. On the the market misbehavior live chart list, I would look at this set of charts. This is the relative performance of the growth sectors, relative performance of the value sectors, relative performance of defensive sectors, looking for inflection points where these have been underperforming since the April low. At some point, that's going to stop. I'm looking at this chart every day. I'm going to tell you when it's no longer the case, because that, in my opinion, is probably going to be a really good excuse to say, ooh, maybe there's something different in the market. So second thing I would look at would be the relative performance of some of these key sectors. The last thing I would look at, the RRG, particularly the daily RRG. The weekly RRG, which is what I default to, is good for sort of larger rotations and larger themes. But if you really want to understand when the market starts to change and when something starts to be different, the reason why I often talk about things being different is because that's when opportunities usually are, right? When everything is just kind of slow and steady, things are working, things are not working, you just kind of keep the same position and you ride it out. But when something changes, that's why I like alerts. That's why I look at this set of charts every day, because I'm just looking for something to change. And when something changes, what we call a change of character, that means we might be compelled to take action. But keep a wary eye, a watchful eye on some of those indicators for if and when they actually rotate. Folks, thank you so much for watching. And I see Tony, I actually see the question about sharing the link to the charts from the April bottom. That's actually a really good question. I will put it in the description for this YouTube video as soon as I finish and get things cleared up. I'll put that in the link, so make sure you check it out there. Thanks for watching live. Those of you that did so, thanks for watching on recording. If you're doing that, I'm traveling here the next 5 days or so. Going to be meeting with some people here in Boston tomorrow. Not sure exactly when the show is going to be. I apologize. I can't be more specific about it, but I'll get to it when I can. I'll try to update you on social media when I have a better idea. But for now, have a fantastic evening. And remember, it's always a good time to own good charts. Have a good night, folks.